If you've saved up some money and want to start investing, but you're just not quite sure how or what you should invest in, well, you're not alone because almost 40% of Americans don't own any sort of investment in stocks. You might have heard people talk about this whole investing thing, but maybe you just haven't quite gotten around to actually starting to invest. And I totally get it because this whole thing seems super confusing and you probably have a ton of questions like if it's risky, what kind of assets you should invest in, and a bunch of other things like all of these fancy words like ETFs, dividends, equity, market index. So today we're going to talk about all it is in this video, and I'm going to do my best to explain all of these things in a super simple way to make it really easy for you to understand. We're going to divide this video into 3 parts. First, we'll talk about the basics of investing, like what exactly stocks are and how the stock market works. Then second, we'll talk about what the best investment vehicles are for you as a beginner. And third, we're going to talk about all the common fears and questions that you might have, along with the common mistakes to avoid. Lastly, I'll also share my own personal investing strategy that you can copy. All right, with that said, let's dive right in. The first thing you have to understand is why you need to invest. Let's say you've saved up $1,000. You could just leave it under your mattress or keep it in the bank. But the problem with that is inflation is going to come around and wipe away the value of your money. The $1,000 that you have today could probably buy you a base model iPhone. But in 5 years, a new iPhone would probably cost like $1,500, which means in that time, your money has lost its original value. The $1,000 that you have will be worth less 5 years from now. Each year, the value of our money becomes lower and lower due to inflation. And so the only way we can overcome this is by investing our money into things that grow faster than the inflation rate. For most people, the goal of investing isn't just to hedge against inflation, but it's to grow their money for their retirement and also hopefully become financially free, where they would not have to continue working and trading their time for money for the rest of their lives. So then, what should you invest in? There are so many different things that you could invest in, like real estate, stocks, bonds, index funds, and maybe even crypto. And you might have even heard of some people who invest in watches or fine art. For most people just starting out though, investing in real estate might seem kind of far-fetched and somewhat unattainable as it requires a large upfront capital. So if you're a beginner who's completely new to investing, I think the stock market is one of the best places to start because you don't need to have a lot of money to get started. It's generally low risk if you do it the right way, and it's historically proven to have good long-term returns. Here's a super simple explanation of what the stock market actually is. So let's say, for example, if I were to open a new cafe and let's say after a year, that cafe is doing well and I want to expand and open more outlets. The problem I would have, and what most business owners would have, is a lack of money or capital to expand the business. So in order to get more money, I could sell partial ownership of my company to the public by issuing stocks, which means everyone can buy a small piece of the business and I wouldn't be the only owner of the company. This is an oversimplification, but it's essentially how the stock market works. A company that's seeking to grow and expand would issue stocks and go public through a process called an IPO, or initial public offering. You might have heard some of these terms on the news before, and it's essentially where now the public can buy shares of a company. So then the stock market is a place where people can come to buy and sell all of these different companies' stocks. Like you probably heard about people buying Apple or Tesla stock, and that basically just means that they're buying a share to become a part owner of that company. Technically, if you bought 1 share of Apple, you can now say that you're one of the owners of Apple. In fact, there was this dude who listed himself as an investor in a bunch of these big companies on his LinkedIn page, which I think is hilarious. All right, so then how do you actually make money by investing? Well, there are 2 ways primarily. The first is that we're hoping for the price of the stock to go up over time as the company grows and more people are interested in buying the stock. That would naturally push the price up. So then later on, you can sell it for far more than what you bought it for. This profit that you make is also referred to as capital gains. The prices of stocks would move based on a few different factors, such as how well the company is performing, the overall economy, and most importantly in the short term, stock prices fluctuate based off of the public sentiments. So for example, if Elon Musk were to do some dumb shit, then investors might lose confidence in Tesla and that could cause the stock price to fall. The second way that you can make money investing is through something called dividends. Now, a dividend basically is just how the company shares its profit with all of their investors. So if you own stocks of Coca-Cola or McDonald's, you'll actually receive a portion of the profits in the form of dividends. This usually isn't a huge amount. It's probably going to be like a couple of dollars here and there, unless you own millions of dollars worth of the stock. Then the dividend payout would actually be a significant amount. Okay, so then next, how do you choose which stocks to buy? Should you put all of your money into Apple or Netflix or Google or Amazon? Well, according to Warren Buffett, who's one of the greatest investors of all time, he said that the average person won't know enough to know which stocks to buy. And I agree because analyzing stocks is not an easy thing to do. So instead of trying to figure out which stocks to buy, you'd be better off just investing in an index fund or an exchange traded fund, or ETF. An ETF is a basket of stocks that tracks the movement of a specific index. Now, there are many indexes, one of which is the S&P 500, which I'm sure you probably heard of. So this index, the S&P 500, basically takes 500 of the biggest companies in America and kind of plots an average price value on them. But the thing is, you can't directly invest in the S&P 500 because it is just an index. It's kind of like a number that's published for your information, like how you would have the unemployment rate, the inflation rate. All of these numbers will be published on the relevant government websites. So the S&P 500 index is kind of like that. It's just a number telling you how the 500 biggest American companies are doing at the moment. But thankfully, there are a bunch of ETFs or index funds that you can easily buy that are set to track the movement of the S&P 500 index, which means essentially you're kind of investing in all of the 500 biggest companies in the US just by buying one stock. There are many of such ETFs, and one of the most popular options is the VOO, or the Vanguard S&P 500 ETF. This is a popular choice among investors because it has a low expense ratio of just 0.03%. An expense ratio is basically the fees that you're charged. But if you were to compare it to other investment vehicles like mutual funds or other more actively managed investment products, those would typically charge a higher management fee, and that could easily eat into your profits. Aside from the fees involved, there are also other benefits to investing in an ETF. For example, if you were to buy an individual stock, say Tesla, and you were to put all your money there, if something were to happen with Tesla that causes its stock price to fall by, let's say, 10%, then you would experience a significant impact on your total investment portfolio, because it would now mean that you would have lost 10% of your portfolio. And yes, technically this is just a paper loss because it's just a loss on paper in terms of your portfolio's value. Unless you actually were to sell the stock at a loss, then only does it become an actual realized loss. But compare this to if you were invested in the S&P 500. Tesla is the 9th biggest holdings in the S&P and makes up just 1.65% of the total holdings, which means any stock price fluctuations on Tesla will not affect you directly in a significant way. This is also referred to as diversification because instead of putting all your money into one stock, you're essentially spreading it across 500 stocks. Some of the biggest components of the S&P are companies you'll be familiar with, like Apple, Microsoft, Amazon, Meta, Google, Netflix, and the list goes on. Okay, now let's talk about how do we actually buy the stock. Unfortunately, you can't just go to apple.com and buy an Apple stock like you would buy a new iPhone, because the stocks are not sold on the company's website, but instead it is bought and sold on the stock market, and you're going to need a middleman, which is a stock brokerage company to allow you to buy and sell the stocks. There are many stockbrokers available, and you might have heard of some of them like Robinhood, Moomoo, or Webull, or the one that I personally use, which is Interactive Brokers. So it's really simple. If you don't already have a brokerage account, then I'll leave a link below in the description for you to sign up for one. Once you've created your account and downloaded the app, the only thing that's left to do is to deposit some money into the account so that you can use it to buy the stocks that you want to invest in. For this example, I'm going to use Moomoo, but the steps are pretty similar regardless of which app or trading brokerage you're using. So go to the app and make sure you're logged in. Tap on the Markets tab on the bottom and then tap on the search icon at the top right here. And what you want to do is type in VOO and search it up. This will take you to the VOO stock page. And this is the ETF that we talked about earlier that tracks the S&P 500 index. Right now, at the time of making this video, it's trading at about $500-ish. But the cool thing is, you don't actually even need to have $500. So let's say you've only just managed to save $100 to start investing with. On Moomoo, you can actually buy fractional shares, which means instead of buying one whole piece of the stock, you can just buy a fraction of it at a time. So what you need to do is to click on trade at the bottom here and then hit buy. This will take you to another page where you can set up your order to buy the stock. And over here, you can choose a bunch of things like the trading session. For this, I just leave it to the default, which is the regular market hours plus the pre and post market trading session. The US stock market opens from 9:30 a.m. Eastern all the way until 4 p.m. in the afternoon. But yeah, just leave it at the default setting. And then for the order type, make sure to choose limit order so that you can choose to buy the stock at the price that you want, versus a market order, which is where you buy the stock at whatever price it happens to be trading at that particular moment, instead of the price that you choose. Then in the next option for the price, just leave it as it is based on what's been filled out for you. Now next, with the quantity, here's where you can select to buy a fraction of the stock if you don't have a lot of money to start with. Just tap on this icon right here and then it'll toggle the quantity into an amount selector. And then you can type in however much you have and want to start investing with. So let's say you want to start with $100, then type in $100. And you'll see here it shows that the number of shares you can buy, which is about 0.19. And when you're ready, tap on the buy button and your order will be submitted to the stock exchange. And usually in a matter of seconds, the order will be filled and you will be the proud owner of the stock. You can then monitor the stock's performance and your portfolio all within the app itself. Okay, so now that we know what stocks are, what stocks to invest in, and how to invest it, let's talk about how you should continue to invest over the long term. There are several ways you could do this. One is to save up enough money, and once every year or maybe every 6 months, you could add to your investments and buy more of the stock, or the ETF in this case. Another approach is to do something called DCA, which stands for dollar cost averaging, where instead of saving up for a few months at a time, this is where you would set aside an amount to be invested every single month. Let's say 10 to 15% of your paycheck to buy into the stock that you're investing in, regardless of how that particular stock or the entire stock market is performing. Because sure, ideally, we want to buy in at the best, lowest prices, but there's just no surefire way of knowing when is the best time to buy. So the next best thing is to average out your entries on a fixed date each month. A lot of the stock brokerage apps would actually allow you to do this directly within the app, where you can set up auto transfers from your bank account each month and have the app buy the stock for you based on what you've set. This makes it super easy for you to be consistent and make investing become a habit, because then you don't need to actively think about it or even do anything once you've decided to allocate a portion of your paycheck to be invested in this manner. But if you prefer, you could also learn a little bit of technical analysis, which is basically to look at a stock's charts and have an understanding of what's going on, and that might actually be able to help you to buy the stocks at better prices. I personally do use technical analysis all the time, especially when I'm actively day trading stocks. However, when it comes to investing, especially if you're just a beginner, then doing DCA would be the best and simplest option. Okay, now let's talk about a few things that you have to do before you even start investing. First, make sure you've paid off any high interest debt that you might have. For me, I consider anything above 10% to be high interest. So if you have some unpaid credit card bills with interest rates of over 20%, focus on paying that off as quickly as you can, because that is pretty much a guaranteed 20% return in the form of interest that you no longer have to pay for. Because it doesn't make sense to invest and earn a 10% return while you're still paying a 20% interest on any credit card debt. The next thing is, you gotta be okay to leave the money invested for at least the next 3 to 5 years minimum. So don't invest any money that you're gonna need for your bills or living expenses in the short term. All investments carry some degree of risk, so you don't wanna be caught in a situation where your portfolio is down and you need to use the money urgently for whatever reason. Which brings us to our next point, and that is, you need to have an emergency fund set aside to act as a safety net just in case something would have happened and you needed the money urgently. You don't want to be in a situation where you'll be forced to have to sell your investments to cover an emergency expense. So once you've got all of this covered and you're clear on your long-term financial goals, then you're all set. All right, now let's talk about some of the common questions and mistakes to avoid when it comes to investing. The first one is, can you lose all your money? And the answer is, all investments carry some degree of risk. But if you were to diversify your investments and focus on long-term growth, then the risk of losing your money is actually quite minimal. Next, how much money do you need to start investing? Well, as you saw earlier, with an app like Moomoo, you can buy fractional shares, so technically you could even start with as little as just $1. All right, now moving on. Here are 2 common mistakes that new investors tend to make. First, they would check their investments all the time, almost every single day. And this is a bad habit because the market will fluctuate each day, and constant monitoring of your investments can lead to emotional decision making. Like if Trump were to tweet something about the tariffs, then that could cause stock prices to fall and lead some investors to panic sell. Instead, you want to focus on the long-term growth and not worry about the short-term price fluctuations. Secondly, don't chase any sort of hype or follow whatever's trending on social media, like a couple years ago with meme stocks like GameStop and AMC. In my opinion, this is not a sustainable investing strategy for the long term, and you're way better off sticking to investing in strong, quality companies in the S&P 500 index. Now, at the start of the video, I promised to share what I'm personally doing as far as investing in stocks. And so to answer that, we gotta pause for a second and think, at the end of the day, what's the point of investing? Well, obviously it's to have your money make more money for you. But realistically though, let's say you have $1,000 saved and you invested it in the S&P like I showed you. With an annual rate of 10%, you would make $100 after an entire year. And $100 doesn't feel like a whole lot, especially in this current economy. Now, this doesn't mean you shouldn't bother investing altogether, but for me, I'm prioritizing investing in things that could yield a higher return for me in the short term. So instead of putting all your money into the stock market, you might want to consider investing some of it in acquiring new skills to be able to make more money. So let's say, for example, again, if you just had $1,000, you could attend a course and develop the skills that could easily make you far more than just the 10% or $100 that you would get in the returns from the stock market. So this way, if you did both of these things, you would be able to grow your ability to make money now and also be sure to have enough money invested later on for your retirement. What I'm personally doing is I'm investing my money in growing my current business, and I'm also growing my money through active day trading. I've been day trading stock options for a couple years now, and it's basically just like investing where I buy and sell a stock. It's just on a much shorter time frame. Of course, it all carries its own set of risks, and that is why in day trading, one of the key factors is having good risk management. I do sometimes talk a little bit more about day trading over on Instagram, so if you're interested to know more, be sure to follow me there. Anyway, I made a video talking about how you can go from $0 to $100,000 quickly in under a year, so be sure to check it out. I hope you guys enjoyed the video. Please drop a like and subscribe if you haven't already. For now, thanks so much for watching, and I'll see you in the next one.